So now let's start. Let's start with question number 1. And kindly don't copy. Don't copy. Don't copy. Consider a project whose initial investment is 40 million. The cost of capital is 12%. Its economic life is 5 years. And the following cost and revenue are provided. So we have the revenue, that's the amount and the probability. Cost, we have the amount and the probability. Then we have the random numbers for each variable, that's for the revenue and the cost required. Evaluate the project using simulation analysis. So that under simulation analysis, step number 1 is to identify the objective. And you see that in financial management, the objective is 1, determination of NPV. So this is the determination of the net present value. And then step number 2, you determine the input variables. And identify the variables by the virtue of their probabilities. And in this case, we have the revenue and we have the cost. Then the next step, you prepare the Monte Carlo or the probability distribution for each variables. In this case, we have 2 variables. Therefore, we prepare 2 Monte Carlos. So we prepare the Monte Carlos. 1 is for the revenue. Whereby we have the amount. We have the probability. Then you accumulate the probability, and then we range, whereby we have 40, 50, 55, and 60, 0.15, 40, 30, 15. Then you accumulate the probability. We have 15, 55, 85, 1.00. And then we range. You see that when you're ranging, we use the cumulative probability, assuming they are whole numbers. This is 15, 55, 85, and 100. So it will be 0, 0. This is 15. You minus 1, you get 14. Then you start from the next number, which is 15. This is 55. You minus 1, you get 54. Then you start from the next number, 55. 85, you minus 1, you get 84. Then 85 to 99. Then the other Monte Carlo is for cost. For the cost, we have the amount. We have the probability. You accumulate. Then you range. You have 25. You have 30. 35. Then we have 40. Then you have the probability. 0.1, 0.25, 0.35. 0.30. Then accumulate our probability. 10, 35, 70. And then you range 0, 0. This is 10. 10 you minus 1, you get 9. Then from 10 to 34. Then 35 to 69. And then 72, 99. So that was the 3rd step. Then the 4th step. The 4th step, you determine the logic of the model. Now, the logic of the model is all about, here we have 2 variables. How can we use this information so as we attain our objective? That is determination of NPV. And then the logic of the model is what will guide us on how to come up with the simulation worksheet. Come up with the simulation worksheet. And the simulation worksheet depends with the logic of the model. So we start with the number of trials. Now, the number of trials depends with the random numbers given. How many random numbers do we have? We have 5 of them. So then the information we have the revenue. So we'll be taking the revenue. Then we minus the cost. And once you take the revenue minus the cost, we are able to get our cash flows. We are going to get our cash flows. And then since we have prepared 2 Monte Carlo for the revenue and the cost, you divide them by 2. That is for the revenue divided by 2. One is for the random number, the other one is for the amount. Also the cost the same, a random number and the amount. And now let's start with the revenue. For the revenue, we had the random numbers. We have 37, we have 20, we have 56, 19, and 47. For the cost, we have 84, we have 01, we have 89, we have 18, and we have 48. Now let's use the Monte Carlo to get our amount. It's a trial and error method. So for the revenue, we use the range to determine the estimated amount. The first one is 37. That 7 lies in between 15 and 54. Therefore, the expected revenue is an amount of 50, 20, also 50. What about 56? 56 we have is 55, 19. 19 is 50, 47. We have is 50. Then we have costs. For the cost, we use the Monte Carlo for cost. The first one is 84. 84. It's 40, 01, 89, 18, and then 48. Then you get the cash flow. So for the cash flow, you can take the revenue, call it A, this is B. You take A minus B. 50 minus 40, you get an amount of 10. 50 the revenue, minus the cost of 25, you get an amount of 25. 55 minus 40, you get 50 minus that, you get 50 minus that 5, you get 15. And those are our cash flows. So in this case, we are not given the tax rate. If you're not given the tax rate, you assume that those are the net cash flows. Once you get the net cash flow, then we discount. Now, note that we say that these are the number of trials. These are not the periods. That's where most of you were wrong. Whereby, when discounting, they discounted as year 1, year 2, year 3. The trials are independent. These are trials, they are not the number of years. So we say that each trial is independent. For example, the first trial, the net cash flow is 10 million. You assume that's what you will generate for the next 5 years. So therefore, it's an annuity. So present value interest factor of an annuity, the cost of capital was 12%, and the project was how many years? 5. So we use the annuity table to get 3 points. And now, if you take the cash flows, then you discount, that's how you get the present value of cash inflow. Once you get the present value of cash inflow, you raise the present value of cash outflow, and that's how you get our net present value. Good. So now give me the present value of cash inflow. So this one you get an amount of 36.048. 90.12. Sorry? 0.07. 72.1. 54.07. Then you deduct the present value of cash outflow. How much was the cost of the project? The cost of the project was 40. So to get NPV, you take the present value of cash inflow, you raise the present value of cash outflow. This one you get negative 3.952. This one you get an amount of 50 point. Here you get an amount of 14 point. Here you get an amount of that 2.1, and you get 14.07. Now give me the total NPV. All right. 106.408. So that's the total NPV. Then you get the average. The average is what you call the expected NPV, whereby you'll be taking the total net present value, you divide by the number of trials. The total NPV was 106.408. And then we have conducted 5 trials. You get the average. How much will be the average? 0.28. You can take a screenshot. Question number 2. Let's go to question number 2. Now, number 2 was on replacement analysis. Hope you remember the steps followed when evaluating on whether to replace an old machine with a new one. So you do question number 2. Yeah, we say that under replacement analysis, there are 6 steps which are followed. What was step number 1? Number 1, you are to determine the incremental outflows. That's the present value of cash outflow. And how do you determine the incremental outflow? By taking the cost of the new asset, and then you capitalize, you add the installation or the modification cost. Then you also add the working capital. Then you deduct the market value of the old asset. And then you add the capital gain tax. Yeah, in case you have to dispose this old asset at a gain, that's when you pay the capital gain tax. And how do you get the capital gain? So by taking the market value of the old asset, you deduct the net book value of the old asset. Then step number 2, you determine the incremental depreciation per annum, whereby you'll be comparing, you take the depreciation per annum of the new machine. Then you deduct the depreciation per annum of the old machine, of the old asset. Then step number 3, you determine the incremental salvage value. Kindly don't copy. So to get the incremental salvage value, you'll be taking the salvage value of the new asset. You deduct the salvage value of the old assets. And then number 5, you have to determine the terminal benefits. And the terminal benefits. And the terminal benefit is made up of 2 elements. One is the incremental salvage value. Incremental salvage value. Then you also add the working capital. Yeah, we say that the working capital is an outflow at the beginning, then becomes an inflow at the end. And then, this was number 4, sorry. Step number 5, you determine the incremental inflows. And then lastly, number 6, we evaluate using NPV. And now let's read the question. We read the question. Question number 1. Anyone without the question paper? Kazingumu Limited is in the process of modernizing its operation. The factory manager has proposed the replacement of a milling machine with a new fully computerized machine. The milling machine was purchased 2 years ago at a cost of 4 million. So he purchased this machine 2 years ago. The economic life of machine was 5 years. So the economic life of the machine was 5 years, but was acquired 2 years ago. That means the remaining economic life is 3 years. However, a management review has established that the machine has a further useful life of 5 years with a 0 salvage value. So we have done an evaluation now. instead of 3 years, this machine is usable for the next 5 years. Not 3 plus 5, no. From now, the remaining economic life was 3 years. But now after evaluation, this machine is usable for a further 5 years. So in that means that there is an additional 2-year period. Also, you should note that the remaining economic life of the current machine, of the existing machine, will always be equal to the economic life of the new machine. That means even the new machine to be evaluated, it will be evaluated over the same economic period of 5 years. The machine can be disposed of immediately at 1.6. Now, that's what we call the market value of the old asset. If you have to sell it now, we are going to sell it at 1.6. Second paragraph. The new machine has a purchase price of 8 million with an additional installation cost of 1.8 million and a salvage value of 2 million. The new machine will need to increase the efficiency and annual saving in cost of 2.1 million. However, electricity cost will increase by 200,000 per annum. And the operation of the new machine will also require an increase of 500,000 of the working capital. The company uses certain method of depreciation, and the company cost of capital is 10%, and the corporate tax rate is 30%. Required. Advise the management of Kazingumu Limited on whether to replace the machine. Read that question again. Now let's follow the steps, starting with step number 1. How much is the cost of the new machine? It's 8 million. So that's 1,000. Then you add the installation cost. How much will be the installation cost? 1.8. Also, we need the working capital. Now, working capital is current assets minus the current liability. How much do we need? 500. Then you deduct the market value of the old asset. That means if you have to sell the old asset now, we are going to get some cash. Therefore, it will reduce our financial burden. If you have to sell it now, how much is the current market value? 1.6. But if you sell it at a gain, that means if you sell it now at 1.6 and you sell it at a gain, you'll have to pay the capital gain tax, which is an outflow. So that's why we add the capital gain tax. How do you determine the capital gain? You take the market value of the old asset. If you are to sell it now, we are going to get 1.6. You compare against how much is the current carrying amount. That's what we call the net book value. And to get the net book value, you take the cost minus accumulated depreciation. How much was the cost of the old asset? Yeah, the cost of old asset was 4 million. You less accumulated depreciation, you take 4 million. The estimated economic life was 5 years, so that we get depreciation per annum. But we are told that this machine was acquired 2 years ago. So you multiply by 2 to get the accumulated depreciation. So we take 4 minus the accumulated depreciation. You get 2.4. So that means we are going to sell it at a loss of 800. Now, at loss, we don't pay any tax. So therefore, the capital gain tax will be 0. So that means how much do we need now? For us to replace, how much do we need? Sorry? 8.7. 8.7. Step number 2. We determine the incremental depreciation per annum. So depreciation will have an effect on the tax shield benefits by taking depreciation per annum of the new machine. Now, the cost of the new machine will be 8 million. Then we capitalize the installation cost of 1.8 to get the cost to capitalize on initial recognition. But the machine will not depreciate fully. It will be having a salvage value. How much is the salvage value? 2.2 million, so that you get the depreciable amount. Once you get the depreciable amount, you depreciate for the next 5 years. So how much is that? Get 1560. Then you raise depreciation per annum of the old machine. Now, for the old machine, we have done a revaluation. If you have done a revaluation, now you factor in the current carrying amount. And the current carrying amount of the old asset is 2.4. In this case, the original cost will not be used because we have done a revaluation. So the current value of the existing machine is 24, of which now it's usable for the next 5 years with a nil salvage value. Therefore, you depreciate over the next 5 years. So how much will the depreciation per annum? 480. And thus I will get the incremental depreciation per annum. 1080. And then number 3, you determine the incremental salvage value. Now for the incremental salvage value, you take the salvage value of the new asset, which is 2 million. You raise the salvage value of the old asset, which will be having a nil salvage value. Therefore, the incremental salvage value will be 2 million. And then step number 4, you determine the terminal benefits. Now for the terminal benefit, you take the incremental salvage value, which is 2 million. And then at the end, you recover your working capital. Working capital is an outflow at the beginning, then becomes an inflow at the end, an amount of 500. And you get an amount of 25. Then step number 5. Step number 5. We determine the incremental inflows. And now let's go to the second paragraph. The new machine has a purchase price of 8 million with an additional installation cost of 1.8 million and a salvage value of 2 million. The new machine will lead to increased efficiency and annual saving in cost of 2.1. Now, a cost saving is an inflow. However, electricity cost will increase by 200,000 per annum. The operation of the new machine will also require an increase of 500,000 shillings of working capital. And the company uses straight-line method of depreciation. The company cost of capital is 10%, and the corporate tax rate is 30%. So to get the incremental inflow, so we have the incremental cost saving, incremental cost savings. With the acquisition of the new asset, the operational cost will reduce by 2.1. A cost saving is an incremental inflow. But electricity bill will increase. So you raise the electricity cost. And the electricity cost will increase by an amount of 200. Good. And that's how we get our earnings before tax. Since we are given the tax rate, we get an amount of 1.9. Then we tax at the rate of 30%. 190 times 3, you get 570, and that's how we get the earnings after tax. Get an amount of another 1330. Then you convert the accounting profit into cash flows by adding depreciation tax shield benefits. You take 30% of the incremental depreciation per annum. Incremental depreciation per annum was 1080. 108 times 3, you get 320. 324. And that's how we get our annual cash flows. You get 1650. Good. Then step number 5, we are to evaluate using NPV. So to get NPV, we already have the annual cash flow. So we just need to discount, and the cost of capital was 10%. So present value, interest factor of an annuity, 10% for 5 years. And you get 3.708. Good. And that's how we get the present value of an annuity. Sorry? 60? 6270. Then we add the present value of terminal benefits. The present value of the terminal benefit. Now, these are terminal benefits. The terminal benefit was 2.5. So take 2.5, then you discount present value interest factor. This is not an annuity, it's a terminal benefit. So therefore, it's a one-off at the end of year 5. So 10% at the end of year 5. So use the first table, 2,500 times 0.09. Sorry? 1552. 1552. So you add the two to get the present value of cash inflow. Get 70. 7820. Then to get NPV, you raise the present value of cash outflow. The present value of cash outflow was our step number 1, an amount of 87. And that's how you get NPV. Sorry? Yes, what are you saying? 87, which is negative, right? Now the question was, advise the management of Kazingumu Limited on whether to replace the machine. Should we replace the machine? They should not replace. So take a screenshot. If you understand, you don't have to take a screenshot. After all, it's a revision. Or if you're a gallery knowing very well how to revise. If it's something is simple, you don't have to. Not unless the question is complex, you can refer. You don't have to take a screenshot because I have said you take a screenshot. If you got it right, for the card, if you got it right, do you need another? No, don't feel your gallery. After all, it's a revision. Question number 3. Question number 3. Question number 3. Number 3, I told that Kipenzi Limited has 2 mutually exclusive projects, namely Project A and B Limited, with an initial outlay of 50,000 each. So the 2 projects are mutually exclusive. So that means they are substitutes. They compete against each other. So that means you just need to choose one. The project has a useful life for 5 years. The company cost of capital is 12%, with a corporate tax rate of 30%. The expected cash flows for the project before depreciation and tax were given as follows. So what we have is earning before depreciation and tax. We have for project A, if you look at project A cash flows, they are the same. So that's an annuity. Then we have for project B. The company uses certain method of depreciation required using NPV and profitability index. Advise the management of Kipenzi Limited on the project to undertake. It's either A or B. So first of all, you get the depreciation. Both projects, the initial cost is the same. So it's 50,000. You divide by 5. 50 divided by 5, you get 10, right? Now let's start with project A. Now, project A, what we have there, the cash flow are the same. So you don't have to evaluate for all the 5 years. So that's an annuity. So you take the earning before depreciation and tax, which is an amount of 42. Then we tax. The tax rate is 30%. We tax at the rate of 30%. 4.2 times 3, 12.6, right? 12.6. And that's how you get the earnings after tax. An amount of, sorry, 29 point. You convert the accounting profit into cash flows by adding depreciation tax shield benefits. You take 30% of the depreciation per annum. Depreciation per annum was an amount of 10. So therefore you get an amount of 3. And that's how you get annuity cash flows. Simple. You get that 2.4. Or alternatively, you can take 42, which will be the earning before depreciation and tax. We raise depreciation of 10, so our shillings are in thousand, so that we get the earnings before tax, which will be an amount of that 2. Then we tax at 30%. 3.2 times 3, you get 9.6, right? Now give me the earnings after tax. You get 22.4, and then we add back depreciation, which was an amount of 10. And that's how we get our cash flows, which will be an amount of that 2. Once we get the annuity, then we discount. The cost of capital is 12%. So present value interest factor of an annuity, 12% for 5 years. That is 3.6048. Now give me the present value of cash inflows. Give me the present value of cash inflows. Sorry? 116.8. So to get NPV, you raise the present value of cash outflow, which we have invested an amount of 50. How much will be the NPV? 66.8. What about the profitability index? Present value of cash inflow over the present value of cash outflow. So the present value of cash inflow, we have 116.8. Present value of cash outflow is 50. You get 2 point. 2 point. Give me into 2 decimal places. And that's we are getting 5 marks. Now let's go to project B. This was project A. Project B is also for 5 years, but project B, the cash flows are not the same. So if the cash flow are not the same, so we evaluate for each year. 1, 2, 3, 4, 5. So you have the earning before depreciation and tax. Here we have is 62, 32, 22, 52, and 52. Then we tax directly at the rate of 30%. 6.2 times this is 18.4.6, right? 3.2 times this is 9.6, right? This is 6.6. This is 15.6, right? And this one is still 15.6. And that's how you get the earnings after tax. Give me the earnings after tax. 43.4. Sorry? Fifth one is, it can't be 10.4. 36.4, 36.4. Sorry? 22.4, 0.4. Then we add depreciation tax shield benefit. Depreciation per annum was the same, 10, 10, 10. So you'll be taking 30% of 10, which is an amount of, and that's how we convert the accounting profit into cash flows. This one will get an amount of 46 point, you get 25 point, you get 18.4, you get that 9.4, that 9.4. Then we discount present value interest factor. The cost of capital is 12%. We are using the first table since this is not an annuity. And you get 0.89. Sorry? 29, you get 0.72, 0.60, and 0.74. Good. Now give me the present value. The last one, 0.36. The first one, sorry, 0.43. The third one, sorry, 10. Which one? The second one. The third one is 13.097. Where Ruth goja nimalize swali, I'll give you time to take a screenshot. Second one is 20.25. What about this? 25.04. Now give me the total present value of cash inflow. Give me the total present value of cash inflows. $122.18. So to get NPV, you raise the present value of cash outflow, which was 50, and the net present value will be 72.18. Then we get the profitability index, which is the present value of cash inflow. You divide by the present value of cash outflow. 122.18 over 50, you get 2.44. Now remember the two projects were mutually exclusive. You just need to select one. They are serving the same purpose. Now, in terms of NPV, project A is 66.8. That is 72.18. Which one is the best? B, higher. In terms of profitability index, automatically the one with the higher NPV will be highest, because profitability index shows the ratio between the inflow and the outflow. So in this case, it's 2.34. This is 2.4. You take the one with the highest. So therefore, you should undertake project. You get your 10 marks. So can take a screenshot. Now, some students are asking question here. I remember I had shared two cards. The one I'm revising is for the evening student, and I had shared it to the group. Actually, that's the card you did. I'm revising for the evening and the part-time. I'll come to revise for the day class. So that means some of the students who are here, they are not in my groups. And that's why they're asking, where are these cards? I shared them. Let's do question number 4. Now, question number 4 was on bond refinancing. Yeah, I had tried to balance this your cut. And actually, those who got above 25, they are less than 20%. I don't know what happened. And these are the things we have already done in class. Question number 4. Was that cut hard? Eh? Si ngumu. Saizi mmeona sio ngumu because I'm the one doing. Eh? You'll never get a hard cut. It's something that you can be able to, but now if you don't do revision, itamulemea tu. There are those who even got time. Most of the online students who are not monitored. Wakafanya even for 3 hours. After all, then unapata uko na 6. That's the good thing with math. Hii si kama theory ni kucopy paste venye tu iko. Hii hata ukope, the only thing inaweza kusaidia ni format. Only the format, even if you have the materials. Na najaribu kumwambia fanya revision amfanye. Kuna class ya revision mnaingia nyinyi wote. That one does not add any value. Wacha nimwambie ukweli. That one does not add any value. If you don't practice, it won't add any value. Hata mko mnapewa revision daily basis na uattend zote, it won't add any value. Sasa shida inamwambiaga ukweli, mnasema John Mark sasa naye anatuambia aje? Namwambiaga ukweli. Telling you this from the experience. Hata hii tulivise. Sasa mnaona ikiwa rahisi. Mnaona saizi ni rahisi because I'm the one doing. Hata nimwambia kuna class nyingine mkuje muattend hizi saizi. Then I copy paste the way they are nimpatie. Mnapata 10. Why? It's a matter of revision. Hebu angalia wao wamepata za juu. Hao wote ni wenye wananitianga assignment. They always come to my. Na wamakia wakianguka naweka kiasi kikubwa na mwambie hapo ulikuwa unafanya hivi. Do you think that mistake will be transferred to an exam? It won't. Lakini wewe ukikaa hapa ufanyangi assignment ama ukifanya you don't submit. So unakaa na makosa yako hapo ukifikiria nitalipeana assignment na nimefanya, lakini kitu umefanya does not make any sense. So why don't you just submit? I mark, nikwambia hapa you are not supposed to do this. This is what you're supposed to do. You have that opportunity. Lakini mnagojanga the last week ya exam unaanza kuniuliza maswali. By the way, I always check. If you have not been submitting my assignment, then kule mwisho kikiumana, that's the time you're asking me the question. I don't answer, to be honest. Because now mpeanga opportunity. Now you have time to do this correction. I'm tracking. Time ya mwisho ikifika anafanya revision na classes mingi, ndio mnataka kuni nini. Then anatuma after 5 minutes. Nimekutumia swali na uangalie. Anagoja within 5 minutes tu umeangalia na umemjibu. I always check at the records. Because ukinitumia najuanga, student wanakuanga active. Hata kama ni online, hata kama sina namba yako, I'll just take at the chat. Kati alifanya, alisubmit, assignment analetanga, lakini nikiona iko clear, au utajisort. Because you had the time to do the assignment. After all, nyinyi najaribu kusaidia, sio mimi. I'm not being tried to be tough to you. After all, si mkipita nyinyi mnaniambianga, because mkipita mnakuanga happy. Because the hard work imezaa matunda. Lakini hata nimwambia hata tumpe classes ngapi, no matter how many classes we give you, if you don't do practice, it won't make any change. Because these classes, I'm the one who are solving them. So I'm trying to make your work easier. So if I make your work easier, you relax. Unafikia vitu zinakuanga hivyo. Mkipewa wakati mnahepa. Lakini time ya revision unatokelezea. Anyway, question number 4. It's a bond refinancing. Now for the bond refinancing, I gave you the format. There are 3 steps which are followed. Step number 1 is to determine the incremental outflows which is required for refinancing. And how do we get the incremental outflows? Is that number 1, you take the core premiums, then you add the overlapping interest charges, then you add the issue cost or the issuing cost or the flotation cost of the new bond. And then also you factor in the discount on issue of the new bond. Then these costs are allowable for tax purposes. So therefore you deduct the tax shield benefits associated with number one is the call premium. The other one is the overlapping interest charges. Then you also add the unamortized this. Who is that? Unamortized issuing cost of the old bond, and then you factor in unamortized discount cost of the old bond. And then the second step, you determine the incremental cost savings. How do you get the incremental cost saving? By comparing the cost of the old bond against the cost of the new bond. Whereby you factor in the major expense of the bond is the interest. Then remember, this interest is allowable for tax purposes. So therefore it will attract the interest tax shield benefit. So you raise the tax shield benefits associated with number one is the interest. Number two is the amortization per annum of the issuing cost, as well as the amortization per annum of the discount cost. And then lastly, we evaluate using NPV. Evaluate using the net present value. You just need to get the format. With the format, application becomes easier. Let's go to note number 4. Avibes Company Limited made a 20 million shillings bond issue 5 years ago when the interest rate was substantially high. The interest rate have been falling, and the firm now wishes to retire this old debt and replace it with a new and a cheaper one. That's about refinancing. Given below are the details about the two bonds issue. For the old bond, the outstanding 20 million bond has a par value of 1,000 shillings per unit. Yeah, that means per unit means per bond. And a coupon rate of 20%. So that means they usually do pay an interest of 20% of the 20 million per annum. They were issued 5 years ago with a 25-year maturity. 25 years to maturity was issued 5 years ago. So that means the remaining period is 20 years. So that means even the new bond, it's all about replacement analysis. Even the new bond to be analyzed should be having the same period of how many years? 20 years. Good. They were initially sold at 5% discount to attract investors, and the firm incurred a flotation cost of 450,000. The bond is callable at 150 per unit. Callable, that's what we call the call premium. So that means if you are to retire today, you are going to pay a penalty of 150 shillings per unit. And then we have information about the new bond. The new bond issue of 20 million would have 1,000 shillings per value per unit and a 15 coupon rate. So the new bond, at least the interest rate is lower from 20% now to 15%. They would have a 20-year maturity period and will be sold at 10% discount to attract investors. Flotation cost of the new bond is estimated at 550,000. Flotation cost is the cost of raising new funds. Assume a 2-month overlapping period. So that one will give us the overlapping interest charges. And the corporate tax rate is 30%. The firm cost of the debt is 8% required. Determine the net present value of the bond refinancing and hence advise the company accordingly. Now read that question slowly. So now let's start with step number 1. You determine the incremental outflows. So you take the call premium. Now the call premium is the penalty for retiring the old bond before its maturity. And that one we are given for the old bond. Now for the old bond, there is the last sentence. The bond is callable at 150 per unit. 150 per unit. So how many units do we have? Now this is very simple. This is what you do. How much is the value of the bond? The value of the bond was 20 million with a par value of how much? 1,000, so that you get the number of bonds. Once you get the number of bonds, it's callable at 150. So the penalty for each bond will be 150. Once you get the number of bond, and then you multiply by 150 shillings per bond. So how much will be the total? You get 3 million. So the penalty to pay is 3 million. Then there is the overlapping interest charges, of which we are told that assume a 2-month overlapping period. Now, for the overlapping period in this case, you factor in the interest of the old bond, the interest of the old bond. Remember, you are paying an interest of 20% per annum of the 20 million, so that you get the interest for the period. But in this case, the bond refinancing will take 2 months. So that's why that assume a 2-month overlapping period. So 2 over 12 to get the interest for the 2 months. Sorry? What are you getting? Soma venye imeandikwa kwa calculator. 666. 667. Good. Now let's go to the new bond. The new bond issue of 20 million would have 1,000 shillings per value per unit and a 15% coupon rate. They would have a 20-year maturity and it would be sold at 10% discount to attract investors. So the discount on the issue of the new bond will issue it at a discount of 10%. So it's 20%, 10% of 20 million. That means you'll give a discount of how much? 2 million. Then after that, the flotation cost of the new bond is estimated at 550. So the issuing cost of the new bond is what we call flotation cost. The cost will be 550. Then these costs are allowable for tax purposes. So therefore, they'll reduce the expenses as a result of tax savings. So you raise the tax shield benefit associated with the call premium. The call premium is 3 million. Then the overlapping interest charges of 666, 667. Then you factor in the unamortized issuing cost of the old bond, unamortized. You see, the issuing cost of the flotation cost is a preliminary expense, which should be capitalized and then depreciated or amortized over the economic period. So therefore, it has some tax savings. Let's go to the old bond, the old bond. The outstanding 20 million bond has a par value of 1,000 per unit and a coupon rate of 20%. They were issued 5 years ago with a 25-year maturity. So that means we have already amortized this cost for the first 5 years. So now we need the unamortized for the remaining 20 years. They were initially sold at 5% discount. Now let's start with this. An amortized discount cost of the old bond. They were issued at a discount of 5% of 20 million. How much is that? Is it 1 million? It's 1 million. And the firm incurred a flotation cost of 450. So incurred a flotation cost. So the issuing cost of the old bond was 450. Now listen up here. So what we need is the unamortized element. So you're supposed this 450 and the discount we are supposed to amortize over the next 25 years. But it was issued 5 years ago. So therefore you have already amortized for the 5 years. The unamortized element for the remaining 20 years, that's what we need. So what you do, for this 450, you minus the amortized element. That is 450 was supposed to be amortized for how many years? 25, so that you get amortization per annum, but it was issued 5 years ago. So you get the accumulated amortization. Then you take the full amount, you less what you have amortized. Now the balance is what you call unamortized. 360,000, right? Yes. 360. What about discount? It was issued at a discount of 1 million. So you minus what you have already amortized, so that we remain with an amortized. 1 million, the bond was for 25 years, so that you get amortization per annum, but it was issued 5 years ago, so that you get accumulated amortization. You get 800,000, right? 800, good. Now give me the total. How much will be the total cost that will qualify for the tax shield benefit? Sorry? 4826, 667. Then what we need is the tax shield benefit. How much was the tax rate? Give me 30% of that. Give me 30% of that, so that we get the tax savings. Sorry? 1448,000. Then you deduct. Remember, it was a tax saving, so therefore it minimizes our cost. So how much is that? You get an amount of 4768. 667. That means for us to refinance, that's what we need now. What about step number 2? You determine the incremental cost savings. So the major expense for the bond is the interest. So you factor in the interest. The old bond, how much was the coupon rate? It was 20% of 20 million. So that means per annum we are paying an interest of how much? It's not 400,000, no. Is it 4 million? What about the new bond? How much is the coupon rate? 15% of which we have issued at 20 million. That's 3 million, right? Good. Then you deduct the tax shield associated with number 1 is the interest cost. The interest is 4 million. This is 3 million. And then we factor in the amortization per annum of the issuing cost. The way we claim depreciation tax shield per annum, these were costs. They are intangible, so therefore we amortize them. Now let's start with the old bond. Old bond. The issuing cost of the old bond was how much? Iko hapa, kila kitu iko hapa. How much was the issuing cost of the old bond? The issuing cost of the old bond was 400 and then we are supposed to amortize for how many years? It was for 25 years so that we get amortization per annum. Sorry? Sorry? 1800, 18,000, 8,000, eh? 18,000, not 1.8, eh? What about amortization per annum of the discount cost for the old bond? So how much was the discount on the issue of the old bond? Iko hapa, iko hapo, kila kitu iko hapo. You have already computed. The discount on the new bond, old bond was an amount of 1 million, of which the bond was for 25 years. So you divide by 25 to get the amortization per annum. How much is that? Sorry? 40,000. So now give me the total. What we need is the tax shield benefit. You multiply it by 30%. $1,217, 400. So you minus. So now take 4 million minus the answer. You get 27. 8,600. Good. I will do the same now for the new bond. For the new bond, we need amortization per annum of the issuing cost. So how much is the issuing cost of the new bond? The issuing cost of the new bond is 550. We amortize the new bond in how many years? 20. So how much will be amortization per annum? 55 divided by 2 get? Sorry? 27,500. Then discount cost of the new bond. How much is the discount cost of the new bond? The discount is how much? 2 million. Then we amortize for 20 years. Is it 100,000, right? Good. So how much will be the total? Then you multiply by 30%. So how much will be the tax shield benefits? You get an amount of 9? 9, that's it? 250. 3 million, you minus that one, you get an amount of 20? 2060? 750. Good. So now how much will be our cost savings? So that to get the cost saving, you take the old bond cost minus the new bond cost. Now, the new bond, the annual cost was an amount of 27,82,600. But now with the new bond, the annual cost will be an amount of how much? 20,61,750. So how much will we be saving each year? 728. This is what we'll be saving each year. And the cost saving is an incremental earning. So now you ask yourself, is it worthwhile? So step number 3, we evaluate now using NPV. And NPV is the present value of cash inflow. You raise the present value of cash outflow. So to get the present value of cash inflow, now this will be the cost saving. A cost saving is an incremental earnings. So you'll be saving an amount of 728.50. Then you discount. How much is the cost of the debt? Present value interest factor of an annuity, 80% for 20 years. 8% for 20 years. Got 9.8181, eh? So give me that. Remember, this is the cost saving for the next 20 years. Sorry? 7077. 377. This is the present value of cash inflow. To get NPV, you raise the present value of cash outflow. The present value of cash outflow we have in step number 1. was an amount of 47,68,667. And that's how you get NPV. Sorry? 23? 08? 710. Now we comment. Should we refinance? They should refinance or refund the bond. Take a screenshot. And now let's do the last one. And question 5, you told that. Afm Limited has a potential investment opportunity of which the initial cash outlay and the future cash flows are uncertain. The analysis carried out provided the following probability estimates. So we have the cash outlay, we have the amount and the probability. So that means even they are not sure about the amount they need to invest in this project. So therefore it's a variable. Also for the cash flow, you are given the probability. It's another variable. They are unsure. Additional information. The cost of capital is 10%. Life of the project is expected to be 10 years with a nil salvage value required. Construct a decision tree for the above project and determine the expected NPV 10 marks. And actually, only I think less than 5% you're able to get this question. Na tuko tumefanya decision making. Did you do the decision tree? Tulifanya? Ama hata hamjui? Yeah, tulifanya ilikuwa rahisi. Actually, the one I did in class was more hard than this. Harder than this. Ilikuwa rahisi because your time nilifanya. So I solved it. So that's why it's easier. If I could have done this question in class, then hiyo mlifanya kwa class nilete saa hizi, mungesema hiyo ndio ngumu. It's a matter of revision. My good people. Yeah. But at least the crying was around. And you call muliria. But the good thing, most of the students tried. Hata wenye walifanya swali moja. That's a nice progress. After all, it's a cut. It won't count in your final exam. His marks hatutapeleka huko, but it will have an influence there. So now we need to construct a decision tree. And then when you walijaribu hata wenye walikuwa wanachora sketch. Sasa shida, you don't follow instruction. Mlikuwa mnachora vitu hazichoreki. What do I say about when coming up with a decision tree? If you are listening to me, you hamukuandika. I told you that the most important thing when I'm teaching is what I say, not what you write. What I say. What do I say about decision tree? You start with a sketch. Then once you have a sketch, then you do what? You draw from behind. For those taking advanced MA, we have a topic in decision making. Waliandika. For financial management hamukuandika, but nilisema. Lakini mlikope notes Kenya mwalimu alisema ndio mliweka. Sasa if you could have followed that, kuchora mungechora vizuri. Watu walikuwa wanachora tu vitu hatu. Hata yeye mwenyewe Kenya amechora. Huwezi jua kama ni working ama ndio sketch. In this case, cash out, they are not sure. How many probabilities do we have? 4. A probability represents an outcome. A probability represents an outcome. We have 4 probabilities. That's the outflow. Now let's go to the cash flow. For the cash flow, how many probability can you see? 3. Those are 3 outcomes. So for each, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. Now that's what you call a sketch. Once you have a sketch, now you need to come up with a fair copy. Draw something that you can tell that this student is answering. It's not part of the workings. It's not a sketch. By drawing from behind. Once you have a sketch, you just need to count the number of endnotes. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Then you draw the fair copy from behind. So you have 12 endnotes. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3. They are from the same source. 1, 2, 3. 1, 2, 3. 1, 2, 3. 1, 2, 3. And then 1, 2, 3, 4. All of them now, they are from the same source. Yeah, if I see this as an examiner, nitaona hata kama hakuna kitu umefanya, at least you did an effort of doing something presentable. I'll give you 2 marks. Ona sasa venye inakaa. Sasa ukianza kuchora ati hivi 1, 2, 3, 4, then realize hapana, hii ni 1, 2, 3, 1, 2, 3, then unafika hapa 1, 2. Then the next step, this is we need to get NPV. For the NPV, what we need is the discounted cash flow. Now let's go to the outlays. Cash outlay. Now cash outlay, we invest at period 0. This is year 0. So we have 250. Capital can be 280. The project can cost 300 or 310. What's the probability that the project cost will be 250? 0.4. This one is 0.25. This one is 0.25. And this is 0. Then we have the annuity, annual cash flow. So therefore, it's an annuity for 10 years. The project was for 10 years. It can either be 45, 50, or 60. 45, 50, 60. 45, 50, 60. 45, 50, 60. And we have the probability. Probability that the annual cash flow will be 45 is 0.2. Here we have is 0.4 and 0.4. 0.2, 0.4, 0.4. 0.2, 0.4, 0.4. 0.2, 0.4, 0.4. Our objective is 1. What's the objective? Objective inakuwa NPV kila wakati, sawa sawa. So with this information, how can you get NPV? NPV is the present value of cash inflow. Do you have the inflows? Usiangalie hapo ziko hapa. Do you have the inflows? We are given the annual cash flow. So the next step you need to do, since we have the cash flow, you discount them to get the present value of cash inflow. It's as simple as that. So, present value interest factor of an annuity. Remember, these were annual cash flows for a period of how many years? 10 years. How much was the cost of capital? 10%. So it's 10% for 10 years. You get 6.6. So therefore, to get the present value of cash inflow, you take your annual cash flow. This is 45, 50, 60, You multiply by the present value interest factor, 6.1446, 6.1446, 6.1446. Just need to compute the first three. Since these are the same. Give me that. 270. Let's just round off to make our work easier. 277, 307, 360, 45, 50, 60. So they are the same. 277, 307, 369. 277, 307, 369. 277, 307, 360. And that's how you get the present value of cash inflow. Then you deduct present value of cash outflow. Present value of cash outflow ni ngapi? Good. For the first three outcomes, the outflow is how much? 250. So you deduct 250, 250, 250. For the next three outcomes, it's an amount of 280, 280, 280. For the next three outcomes, it's an amount of 300, 300, 300. And lastly, we have 310, 310, 310. And that's how we get our NPV. This one you get an amount of 20. This one you get an amount of 50. And this one you get an amount of 119, right? Here you get negative. Here you get an amount of 20. And here you get an amount of how much? Is it 89? What do you get here? You get negative 30. No, is it 23? You get 7, you get 60. What about this? 23, is it 43? Which is negative? No, it's 33, 33. Here you get an amount of negative 3. Here you get an amount of how much? Is it 49 or 59? 59. Then what we need now is the expected NPV, because in this case, we have the probability. So this is how you get NPV. So how do we get expected NPV? So to get expected NPV is a summation of NPVs times the probability of occurrence. In this case, we use what we call the joint probability. So we multiply by the probability. What's our joint probability? The first one, you take 0.4 times 0. You get 0.0. So here you multiply by the joint probability. This one will be 0.4 times 0.4. You get 0.4 times 0.4. You get 0.25 times 0.2. Get 0.05. 0.05. 0.25 times 0.4. You get 0. That's the same. 0.25 times 0.2. You get 0.0. 0.25 times 0.4. 0.1, 0.2, you get 0.02, right? 0.1, this one you get 0.0, and this one you get 0.04. Now give me the NPV. The first one is 2.16, 9.12, 19.04, negative 0.15. This is 2 point. This is 8 point. This is negative 1.15. This is 0.7. You get 6 point. What about this? Get negative 0 point. Sorry? 6. Here we get negative 0.12. No, is it 0.12 or 0.12? 0.12. The last one, 2.36. Now, to get the expected NPV is the summation of. Now, give me the total. The last one is Oh, this was positive, correct. 59. So therefore, you're getting an amount of 2.36, right? Good. Now give me the expected NPV. Expected is the summation of all the NPVs. You get 49.8. Let's work with 50. Or 49.8. Is it okay? This is other than the other one. Number B of the question. Number B. If the NPV of the project is less than 5 million, ASMEO Limited will be exposed to a hostile takeover. Compute the probability that ASMEO Limited will avoid a hostile takeover. To get the probability, that's why you engage now the concept of the normal distribution. Normal distribution like that, whereby here we have the average X bar. Now, in terms of NPV, this is the average NPV, expected NPV. Then you factor risk element, which is measured using the standard deviation. Then, in this case, the question was, okay, how much is our expected NPV? And the average profit is an amount of 50. Now the question was, if NPV of the project is less than 5 million, now this is the average. So this is above average, below the average. So 5 million, is it above or below the average? Below, so it will be here. Now this is what you call X1. In this case, in terms of NPV, is what you call NPV1, of which you are told that if it's less than 5 million, ASMEO Limited will be exposed to a hostile takeover. If it's less than that, so here we are exposed to a hostile takeover. Now the question is, compute the probability that ASMEO Limited will avoid hostile. What does it mean to avoid? To avoid inamaanisha, if you are below 5, that's when you're exposed to hostile takeover. The probability that will avoid hostile takeover, that means our NPV must be greater than 5. So you shade the region of interest. This is the probability of avoiding a hostile takeover. Then a normal distribution is symmetrical. Symmetrical, that means half-half. All these, the probability is 0.5. All these, the probability is 0. But what we need, first of all, we need this probability. Between 5 million to 50 million. And then we add the other half. And in this case, for normal distribution, Z is equals to X1 minus the average over the standard deviation. For NPV, you'll be taking NPV minus the average, that's the expected NPV, over the standard deviation, and you're given the standard deviation. Assume a normal distribution with a variance of NPV, that's the variance, but you don't need the variance. We need the standard deviation. To get the standard deviation, you get the square root of the variance, which was 1861.47. How much is the standard deviation? 1.4. So therefore, in this case, you'll be taking NPV is 5 minus expected NPV, which is 50, over the standard deviation of 43.14. Then give me into 2 decimal places. 2 decimal places. You get 1.04. Then you ignore the sign. What does it mean if you get a negative? If you get negative, that means it's below the average. If you get the positive, it's above the average. Negative below the average, but that one does not account on this. Now, what we have, this is not the probability. How do we get the probability? We use the normal distribution table. So from the table. Now, take out your past paper. In your past paper, there is a normal distribution table. Can you check either May 2018 or November 2018? Not discounting table, a normal distribution table. You'll see Kaugali on the top. That's how you know that is a normal distribution table. Now check November 2018. Yeah, just check the last page of November 2018. There must be a normal distribution table there. Also May 2017. May 2016, eh? Yaani unanipea hii kazi yote na umenipea FR. Not FR, it's EFM. Hmm? So is that it? Can you see a table like this? Yes. Good. Now, how do you read that table? Now, what we need is 1.40. This is what you do. Angalia hapa. 1.0. Then we have 0, 1, 2, 3, 4. 1.04. Where you have 4. Give me that probability. You get 0.08, eh? Good. Yeah, it's 1.8. Sorry? This is 85. Others are getting 0.35, right? Both of them, they are the same. I'll explain why. Others are getting 0.850. Now let me explain the difference between the two. Let me work with the first one. The first one are those who have used this table. Table imeshedua that region. If you use this table, this is what you get, 0.308. Then you factor in the other half, 0.5. And you get 0.8508. Then there is another table. If yours is colored, you can be able to see, but if it's not colored, hautaona. The other one, imekuwa shaded all the region. What does it mean? Has already factored the other 0.5. Are you getting the difference between the two? Yes, has already factored that. So if you use the first table, this one, that's when you add 0.5. If you use this table, don't add 0.5 because the shaded part has already factored 0.5. So therefore, the probability of avoiding hostile takeover is 85%. Good. And you can take a screenshot. So now I want us to switch. We do the cut for the day students. Actually, only one question that was different. Eh? Only one question that was, no, there were two. There were two. So now the day cut. Let's start with question 5. I think question 5 was different. Question number 5. Using the cut that the day student did. Question number 5 was one of the different questions. Which Amimi Limited is appraising an investment project which has a cost of 20 million payable in full at the start of the first year of operation. That's period 0. The project is expected to be 4 years. Forecast sales volume, selling price, variable cost, and fixed cost are follows. Kuna watu bado hawajapata swali. Na namwambiaga ni simple instruction, namtumia swali mapema. Have this before the class time. Kuna mtu bado hapa anauliza where was the card sent? Anyway. Nilikuwa nimetuma na nikamwandikia text. We'll be revising both cards. Make sure you have them before the class time. So we have the period, we have the sales volume, selling price per unit, variable cost per unit, annual fixed cost in thousands. Selling price and the cost information are in current price terms before applying the selling price inflation of 5%. Inflation is the gradual increase in prices, either cost or the revenue. Variable cost inflation is 3.5% per annum, and the fixed cost inflation of 6% per year. Corporate tax rate is 30%. The company can claim tax allowable depreciation in full initial cost, on full initial cost of 20 million on a 25% straight line. Number 4, Kwisha Mimi Limited has a nominal value after tax cost of capital of 12% and a real after tax cost of capital of 8% required. The nominal NPV of Kwisha Mimi Limited project. So how do you do that? Yeah, most of them, they were not able to get that. They were not able to get that. But me nikifanya, mtaona, it's something that you can be able to solve. To become easy. So we have year 1, year 2, year 3, and year 4. And now let's start with the selling price. Selling price year 1 was an amount of, here we had 125, we had 130, we had 140, and we had 120. But these prices are exclusive of inflation. Inflation is a gradual increase in prices, of which we are told that, number 1, selling price and cost information are in current price terms before applying the selling price inflation of 5% per year. And inflation, when we say that inflation is 5% per year, it's not 5. It's a gradual increase. Are you together? So year 1, if it's 5%, year 2 will be 10%, 15%, 20%. So this is the formula we apply. 1 plus R, it's compounding raised to power N. That's the formula we use. So here we get now inflated selling price at 5%. We apply the formula 1 plus R raised to power not negative, raised to power N. This is what I mean. The inflation rate is 5%, right? So we'll be taking 1 plus 0.05. Now for the first period, raised to power 1. Or you just take 125 times 105. What do you get? Sorry? 1.1 point? Year 2, this is what you'll do. 1.05 raised to power 2. Good. And then the price is 130. You multiply by 130, you get 3, Or alternatively, which will give almost the same answer. Year 1 is 5%, right? Year 2 is also 5%. So it's 5 plus 5. You get 10. So you take 130, you multiply by 1.1. You get 143. Are you getting? But the formula is easier. So the third one, you take 1.05 raised to power 3, 1.05. Then what you get, you multiply by 140. 162.07. Year 3, you take 1.05 raised to power 4. What you get, you multiply by 120. 140? 145.86. Now from there, now we can, then we have the sales volume. Year 1, we sold 300,000 units. Year 2 for 10,000 units. Here you sold 525,000 units. Here you sold 220. Now, can you be able to get now the sales revenue? So to get the sales revenue, you take now the inflated selling price per unit, you multiply by the number of units. So give me that. Sorry? That's 375,000. So, okay, 1,000. The last one, that's 089, 200. 200. Like that, eh? The second one, or that one? The second one, you just take 143 times 410, 58. Sorry? 765. 300. Second one, 85. 086. 750. Good. And then we factor in, there was the variable cost. Also variable cost, there was inflation. So variable cost. And kindly don't dare copy when I'm teaching. Well, just copy, but don't ask me a question. Then we get the inflated variable cost. At how much was the inflation for variable cost? 3.5%. So therefore, we'll be taking 1 plus 0.035 raised power n. So the first one will be 1.035. You multiply by 71. Year 2 square raised power 3 raised power 4. You multiply by 71. You get? 49. Year 2. Year 3. Year 4. Year 2. 70.006. 78. 72. 81.47. Then we have the sales volume. The sales volume, we had 300,000 units for 10 units, 525, and here we had 220. Now give me the total variable cost. So to get the total variable cost, you take the variable cost per unit, the inflated one, you multiply by the number of units. And the last one, sorry, 70, 923, 400. First one, 047, 1,000. That one, sorry, 41, 328,000. That one, 184, 600. And then you also had the fixed cost. Fixed cost, they were in thousands. So this is 3 million, 3.1 million. This was 3.2 million, and this was 3 million. Also, the fixed cost, there was an inflation. Note number 1. The inflation on fixed cost was 6%. So we get the inflated fixed cost at 6%. So it's 1 plus 0.06 raised power n. Here one will be that 180. Which one? The second one? 33? 34? 160? This one you take 1.06 raised to power 3 equals, you multiply by 3.2 equals, you give me the answer. That's it? 11? Sorry? 251, that's 3. That's 7? 87? Sorry? 431. Good. Then you are told that note number 3. Let's go to note number 3. Question, no, note number 3. Yeah. The company can claim a tax allowable depreciation on full initial cost of 20 million on 25% straight line. Hiyo ni Kiingereza tu. It's the same as depreciation is at 25% per. Hii imeisha. Mambo ya tax allowable achana nayo. So therefore, how much is depreciation per annum? 25% of the full cost of 20 million. 500,000? No, 5 million. So it's 5 million each year. But based on the method I use, I'm not interested with the depreciation. What I'm interested in is the depreciation tax shield benefit. 30% of depreciation. This is 1.5, right? Now, what was the question? Now you answer. You determine what? NPV. So NPV is the present value of cash inflow less the present value of cash outflow. Year 1, year 2, year 3, year 4. You take the sales, we raise the variable cost, we raise the fixed cost, and that's how you get the earning before tax. We tax, we get earnings after tax, then we add depreciation tax benefit, and that's how we get our cash flows. Simple. We have the sales revenue. This was 39,375,000. I had 58,765,300. Here we have 85,086,750. This is 32,089,200. Then we have the variable cost. The total variable cost. This is 22,047,000. This is an amount of that 184,600. Then year 3 we had an amount of 41,328,000, and then last we have an amount of 17,923,400. Then we also have the fixed cost. The fixed cost, the inflated fixed cost, this is an amount of that 180. The other one is an amount of that 483. 160. This is an amount of that 811. 251. That 787. For that one. Now give me the earning before tax. Others do year 1, year 2, year 3, year 4. The last one. 14. 800. That 9. 947. 499. Hata hapa makai hiyo imeenda wapi? But it's okay, we can work with 30. The first one 14,1 148,000. 24 097 540. Then tutoe tax at the rate of, hata tuachane na tax. When you pay profit after tax, take your answer, you multiply by 0.7. So that's what I need. You take your answer, you multiply by 0.7. Tuachane na mambo ya tax. The second one 868 278. The last one, first one 99 03 600. The third one 27 963, 249. Good. Last three. Sorry? 991, 6060, eh? Good. Then we add depreciation tax shield benefit of how much? Which one was, this was wrong? Was? This was 1010. This one. Which one? For which year? Year 4 was not 14, eh? Can someone confirm? 17 minus 3, you get 20. So it can be correct. You get an amount of 10? 378. 370. You multiply by 0.7. You get? Sorry? 859. Then we add depreciation tax shield benefits, which was? Yeah, it was 1.5 each year. And that's how we get our cash flows. The last one, you get an amount of 18. Second one, 18. 368. Yeah, you get, sorry? That one, 29. 463. This one, you get amount 11. Now give me the total. No, before we get the total, we have not yet discounted, right? How much is the cost of capital? Let's read note number 3. Note number 4. Wishamimi Limited has a nominal after tax cost of capital of 12% and a real after tax cost of capital of 8%. But the required was the nominal NPV. So how much is the nominal rate? 12. Good. Present value interest factor at 12%. Get 0.8929, 0.7972, get 0.7118, 0.60. 55. Now give me the present value. How much will be the present value? Yes? Which one is wrong? On the first one? It cannot be 8. We are adding, we are not deducting. We are adding depreciation tax shield benefit. Second one, 14, 643, 191. First one, 182, 274. That one, 20, 971, 941. 55, 70, 0, 68. Good. Now give me the total present value of cash inflow. So we had the total for the 4 years. $51, 367, 474. Then to get NPV, that's the present value of cash outflow. Was it 20 million? Good. And therefore, the net present value is that 1,367. Can take a screenshot. The other question that was different was question number 2, but I think our time is over. I'll do that question during our blocks revision. It was under sensitivity analysis. Go and try that for the part-time student. Go and try that. Question number 2. Question number 2. Yes. In an exam. It's still okay. It's still okay. Even if you write them in millions, this accounting provided you show that they are in thousands, they are in millions. But always let's enhance standardization. This is what I mean. For example, when I was marking, for example, fixed cost was 3,000. That one, that two, right? But it could make in thousands. You see now, in this case, I have converted everything, but now the fixed cost was in thousand. Now, instead of taking 3 million, you took 3,000. So that means even when you are deducting here, variable cost 2204, you will only deduct that 180. You should enhance standardization. If one is in thousand, make sure that all the cash flows are in thousands. Are you together? Good. Any other question?